Hello, everyone, and thank you for joining us for another episode of the Financial Commute. I'm your host, Chris Galeski, joined by Wealth Advisor Patrice Bening. Patrice, thank you for joining us.
Thanks for having me, Chris.
When it comes to investing, there's the emotional component, right? Making decisions, and is it the right time to invest? Am I investing in the right things? Time will only tell, and looking back, you always have 20/20 vision. But one of the keys to successful investing that many people point out is the use of dollar cost averaging. Now, dollar cost averaging is buying into investments over the course of time at sequential amounts of money. So like when I contribute to my 401k, every paycheck, a portion of my 401k gets withheld and is invested inside my 401k. So in theory, I am dollar cost averaging when it comes to saving for retirement. But when somebody comes to us with a lump sum, that's when the emotions get a little bit more tied in and say, okay, how am I investing this? Is it the right things? At what price? And so there's some research out there that talks a little bit more about dollar cost averaging and the benefits of it. And even Vanguard, a couple of years ago coming out and saying that dollar cost averaging might not necessarily work, although it's something that we definitely believe in. So when you think about dollar cost averaging and it's buying into investments over a periodic time frame, what comes to mind for you?
I would say right away is that personally, when I first started using dollar cost averaging is when I got the first job that offered me to participate in a 401k. It created a discipline around my investing style because it kind of was a set and forget. I can start with 3% and then change it to 5, 10, whatever it is as, I make more money. But just having that set in place, I didn't have to make a decision every month if I wanted to invest or not just money, but in my personal future self. Yeah. Number two, it helped me avoid the volatility of the market. I actually started in banking in 1999, in September of 1999. I think we all know what happened in 2000. So I think even having to ride through when the tech bubble burst, I really wasn't worried. I was, obviously in my mind, I was still young, but yeah, my portfolio was down, but I was contributing small amounts. And truth be told, I was buying now more shares of investments at a lower price. And, as the market corrected, I was able to benefit from that.
Yeah, when you're saving for retirement, dollar cost averaging really works. I mean, it helps you create a plan that's systematized, that's automatic, and you pick your investment strategy and then the dollar amount you want to invest, and you just systematically follow through with that. But when people are approached with sort of a lump sum to then start investing, whether it's the sale of a business or the sale of a home or some windfall of money, a bonus that they're able to receive, sometimes they're apprehensive about, okay, where am I going to invest this? How much risk am I going to take on? Because they don't want to lose money, and neither do we. And so dollar cost averaging, I believe, helps more with the emotional component of investing. There's some real big tax benefits to doing it as well. But oftentimes, looking back at history with the markets at relatively all-time highs, Vanguard's research in this article, it says 2/3 of the time looking backwards, lump sum investing actually beat dollar cost averaging. And when I look at it, it's looking at the numbers, but not the emotional psyche that comes along with that.
I think people discount a lot how much our emotions come into play when it comes to investing. I tell, my friends and, professionals in my life, I said, investing is easy. You hire people that can follow models. I said it's the emotions around your investing that are hard to manage because, truth be told, we have FOMO, we read the news, we talk to our friends, and then we decide to make decisions that will not be in our best interest. And a lot of time, if we might be even the most experienced investors, but we are notoriously bad at timing the market. And I don't think anyone really can successfully time the market in the long term.
Yeah, studies have shown time and time again that the long-term returns for bonds is, call it 5 or 6%. The long-term returns for stocks, call it 8 to 10. But the average investor only earns like a 2 to 3% rate of return. And it's not because they're investing, it's how they react emotionally to their investment strategy and how they context switch from time to time from trying to get in and out. timing the markets is extremely difficult. In fact, nobody can do it. Otherwise, they would technically be managing all of the money in the world. So when we're approached with a situation to help clients invest, we choose dollar cost averaging here when we're putting money to work in the stock market, maybe into gold or other assets that are designed for growth like real estate. But when it comes to investing in fixed income or more of those stable investment return vehicles, we don't dollar cost average. We put that money to work right away so that way we can get the money working harder for you. But I believe that dollar cost averaging is more of a mental decision. How are you going to feel emotionally if you invest $100,000 today and then all of a sudden it's worth $85,000 or $90,000 a few weeks from now? Because a few years from now, it's likely to be well more than $100,000. So I just find it interesting from that component.
I think, and also something noteworthy to mention is that for me, it turned me from being a short-term investor into a long-term investor. So honestly, if you truly kind of think of it that way and understand the power of compounding returns when my money's making money, that's a beautiful thing. So I think dollar cost averaging, in my opinion, works. There's no downsides to it, just because I am not the expert to tell you if what's going to happen tomorrow is going to be the best decision for me to have for the entire pot of money that I have to allocate.
That's a good point. One of the other reasons why I really like dollar cost averaging, especially if it's with money outside of a 401k or an IRA, is because you're buying some investments at different points in time at different prices. And so those purchases are what's called a lot. So I might own, a number of shares of the S&P 500 at this price and then a lower price and a higher price. And then as time goes on, we're able to look at the portfolio and say, hey, is there any opportunity to do something called tax loss harvesting? Now, we're not in the business to lose people money. But if all of your investments are winning and losing at the same time, you have to ask yourself, am I properly diversified and do I have the right investment strategy? And so that's where tax loss harvesting can be a huge benefit. You sell something at a loss, you buy a similar or like investment to keep that exposure, and you can use that loss to offset future gains down the road. And so it's a way for you to save a lot in taxes. That's one pro as to why you would want to say, I want a dollar cost average. Not only will it help me mentally get this lump sum of money put to work, but also it gives me opportunity to potentially minimize my tax bill down the road.
And I think that actually provides a lot of peace of mind. A lot of us we get hung up when we see our portfolio going down just a bit and think, I'm down 5,000 unrealized loss, right? But there's opportunities within that because we love it when things go up. We don't love it when we have to pay taxes on the things that go up when we sell it.
Right. People get so anchored into, I'll just wait for that to get back to even before I sell it. When that's a missed opportunity because you could exchange it for something like or similar and still get that exposure. But also looking at it, if something went up a lot in value, they get anchored to, I don't want to sell that because I don't want to pay any taxes. It's amazing how the psyche plays more of a role in some of the decisions people make than others. And that's why having a good advisor makes sense. When we were talking about this, you mentioned a few of the emotional and psychological implications of dollar cost averaging. Why don't you touch on a couple of those?
Well, I think we can get very impulsive if we did not have something in place where we can be like, I've had it, I'm going to pull out of the market because I feel like everything's going, down the drain. Honestly, if you really look to see, what the power of having a small amount of money going into an account for whatever reasons, I dollar cost average into my 529 for my kids' 529s. I dollar cost average into a regular brokerage account, and I do it inside my 401k. And I don't think I don't look at it every day to be like, is that amount going up or down? And then what I've noticed that over time, I'm just realizing how wonderful it is to just have this pot of money grow steadily, and I'm not likely to have to make decisions because I don't react to the outside noise that can impact that.
So for you, it sort of reduces anxiety, it improves confidence a little bit,
It does.
and it avoids that emotional decision-making around timing, which are key components to long-term success when it comes to investing. One other thing that when I think about dollar cost averaging, it's like market timing, as we mentioned earlier, is extremely difficult. And we go through seasons within the investment world where it makes sense that certain investments are going to do better than others, whether it's because of interest rates or economic growth. But you could dollar cost average up or down within your portfolio depending on how you're feeling about things. Let's say you've got 50% of your money invested in stocks and you're feeling very uneasy about your financial situation or even what's going on in the economy, and volatility is scaring you because, like, let's be honest, this money means something to you. It is providing you with a future lifestyle. It's helping you pay for a home or a car or kids' education. And we can't take away that fact that emotionally those dollars that we see on the screen are tied to something that we want in our future. And so if you're feeling uneasy, you could work with your team to reduce the stock exposure by a little bit over a period of time and reduce it from 50% stocks down to 30 or 40% stocks, so that way you feel a little bit more comfortable with the volatility, and vice versa. If you've got 30 or 40% in stocks and the markets go down, you can slowly dollar cost average by selling some bonds or some other investments to purchase more stocks when prices are lower, so that way you can benefit from the growth. The key component of that is financial planning. So it comes down to the rate of return that you want to get, so that way it feels good, and then the rate of return that you need to get in order to be successful. Talk to me a little bit about the importance of financial planning and the impact that it has on people.
I think making decisions in kind of in a tunnel, like thinking I want to have $3 million one day, not knowing what that money really means to you, without having the financial plan to back it up, to really understand kind of the components of your life and where you are today, and having kind of the guide and the roadmap that a financial plan really gives you and the clarity around it. So to your point is that if I want that money to check different boxes for me, is how could I plan and how can I make that happen? And allocating and, specifically to those buckets for my kids' education, for my personal retirement, for my vacations. Maybe I want to spend $30,000 a year every year between now and age 85, taking my friends, my family on lovely vacations. I also want to make sure that maybe it's important to me that I don't want to put the burden to have my kids take care of me, and I want to have that kind of bucket allocated so that if something happens, they can just hire somebody for me, and then I know I'm taken care of, and then they don't have to worry about it. So I would say, like, a financial plan, without it, all of our decisions are kind of made in really a bubble, and they don't really have the same impact or meaning to us.
No, you're right. I mean, without a financial plan, I find that people are just making an emotional decision based on feeling and not the actual numbers and the context of what they need. But, like we mentioned earlier, if stocks long-term did 8 to 10% and bonds did 4 to 5 or 6, and then the average investor earns 2.5 to 3, the main reason why that is because people don't stick to a plan. So dollar cost averaging is just one of the key components into making sure that you have a plan for how you're investing, managing risk, and having success long term. So if you're interested about learning more about investing or even wanting to talk to one of our advisors, please reach out to one of us or in the links below.